On a single Monday in August of 2024, stock markets right around the world fell off a cliff. Japan's market had its worst single day since 1987. America's biggest stocks tumbled, and a fear gauge on Wall Street spiked to levels you normally only see in a full-blown crisis. And the trigger for all of it wasn't a war or a bank collapse or a pandemic. It was something that honestly sounds almost laughably small. A central bank on the far side of the planet nudged up its interest rate by 1/4%. 1/4%. That was it. So how on earth could a tiny tweak in Japan knock trillions of dollars off the value of markets thousands of miles away? The answer is a hidden machine that quietly moves enormous rivers of money around the entire globe. It's called the carry trade. Most people have honestly never heard of it. And in 2024, it briefly, violently broke. So to see exactly how a quiet whisper in Tokyo became a full-on scream on Wall Street, we have to follow the money. And it starts with what might be the strangest free lunch in all of finance. Imagine, just for a second, that your bank let you borrow money at 0% interest. Totally, completely free. You pay absolutely nothing for the privilege of borrowing it. Now imagine you took that free money and simply parked it in a safe account somewhere else, one that happens to pay you 5%. You'd be quietly earning 5% on money that costs you nothing at all. Free profit, just sitting there for the taking. That gap between the cheap rate you borrow at and the higher rate you earn has a name. It's called the carry. And pocketing that gap over and over is the entire game. And this isn't some fantasy. For decades, one country offered the closest thing to that free loan on the whole planet: Japan. Japan kept its interest rates pinned right down near zero, year after year after year, desperately trying to wake up its sleepy economy. So here's exactly what big global investors did on an absolutely massive scale. They've borrowed mountains and mountains of Japanese yen, paying almost nothing at all in interest, practically free money by the truckload. Then they converted all that cheap yen into other currencies, mostly US dollars. And they used it to buy things that pay much more: American government bonds, big tech stocks, even high-yielding currencies like the Mexican peso. And every single year, they simply pocketed the gap, the carry. Borrow at nearly zero in Tokyo, earn 5% in New York, and quietly keep the difference. Now repeat that with billions of dollars, and the profits become genuinely enormous. And this was no niche little strategy, either. Analysts estimate the yen carry trade swelled to hundreds of billions of dollars. An invisible river of borrowed Japanese money, quietly flooding into markets all over the world. But here's the part that turns a clever little trade into a genuine stick of dynamite: leverage. Because the borrowing is so incredibly cheap, investors don't just use their own money. They pile on borrowed money, stacked on top of even more borrowed money. Leverage is basically a giant magnifying glass. It makes your gains much, much bigger when things go well, and it makes your losses absolutely catastrophic the moment they don't. And as long as everything stayed nice and calm, the whole thing was beautiful. The yen stayed cheap, the profits kept rolling in, and the trade grew bigger and bigger and bigger still. Everyone involved was very, very happy. But the entire thing rested on one quiet little assumption: that the yen would stay cheap and weak forever. And for years and years, it obediently did, right up until suddenly it didn't. Then, in the summer of 2024, two things happened at almost the exact same moment. First, Japan's central bank, after all those years pinned near zero, finally raised its interest rate to a grand total of 1/4%. Tiny in isolation, but it was a flashing signal. The long era of endlessly free yen was finally ending. Second, some weak job numbers came out of the United States, making investors suddenly think American rates would soon start falling. So the gap, the carry, the entire reason the trade existed, abruptly began shrinking from both ends at once. And the yen, which absolutely everyone had bet would stay weak, suddenly shot upward in value. And that was the spark, because a rising yen is the carry trader's single worst nightmare. Why such a nightmare? Because remember, they borrowed in yen. So when the yen suddenly gets more expensive, the size of their loan balloons. Overnight, paying it all back costs a whole lot more than it used to. And to repay those rapidly swelling yen loans, the traders had to sell off whatever they had bought with the money. So they dumped U.S. stocks, bonds, pesos, basically everything, and they did it fast and all at once. And here's the deadly trap. Thousands upon thousands of investors were all crammed into the exact same crowded trade. So they all rushed for the very same narrow exit at the very same instant. The selling forced prices down, which forced even more panic selling. It's a doom loop. A rising yen forces selling. The selling crashes prices. The crashing prices force yet more selling just to cover the loans. The very same machine that had quietly built the boom slammed into violent, screaming reverse. Which brings us right back to that Monday, the 5th of August, 2024. The unwind hit all at once, and the numbers it produced were genuinely shocking. Japan's Nikkei index plunged more than 12% in a single day, its worst day since the Great Crash of 1987. Decades of careful calm, simply erased in a matter of hours, and it rippled across the entire planet almost instantly. America's S&P 500 dropped around 3%, and Wall Street's fear gauge, the VIX, spiked clean above 65. A level you basically only ever see in a true, full-blown financial panic. And just remember the actual spark for all of this chaos. No crisis, no collapse, just 1/4 point rate hike, way over in Tokyo, gently pulling the very first thread on an absolutely enormous, hidden, over-leveraged sweater. Now, the markets actually bounced back fairly quickly this particular time. Central bankers made some soothing noises, and within a few weeks, most of the losses had been recovered. So was the whole thing just a freak fluke? Not really, no, because the carry trade didn't actually die that day. It just got a very nasty scare. Analysts now believe the trade is already being quietly rebuilt. That same river of cheap, borrowed money is flowing once again. And that is the genuinely unsettling lesson here. Hidden away, deep in the plumbing of the global financial system, are these enormous, invisible, leveraged bets, perfectly calm for years on end, until one small nudge sets off a worldwide stampede. It's a powerful reminder of just how strangely, tightly connected the world's money really is. A central banker in Tokyo quietly clears his throat, and a retirement account in Ohio feels the tremor. So if you strip the whole thing right down, the carry trade is really just that one tempting free lunch. Borrow where money is dirt cheap, invest where it pays more, and pocket the gap. Then supercharge the entire thing with borrowed money. And the catch is that the free lunch is never, ever truly free. You are quietly making one big bet that nothing important changes. And in markets, sooner or later, something always changes. 0.25%. That was genuinely all it took to remind the entire world that the very cheapest money often carries the most expensive surprises of all.